that, can I invite Jitendra to start his presentation? Jitendra, you have between 20 to 25 minutes. I will give you a ping when you're at the 20-minute mark. And I think Ajay is the discussant for your paper, and he'll start for 15 minutes after that, and then we can open it up to the floor. Jitendra, do you want to take this forward?
Yeah, sure. Thank you. Okay. Can you see the screen?
Yes.
Yes.
Okay. And then voice is audible, right, to everyone?
Yes.
Yes.
Sometimes my AC's voice dominates over my voice. So, okay. So thank you, organizers, for including this paper into the program. This is a early work, so any kind of criticism, feedback, comments are highly helpful. So today I'm going to talk about 3 aspects of green bonds. And I will, as I always say, I will try my best to follow this outline that give you motivation and research questions, provide you some old literature regarding green bonds and what kind of data and methodology I'm going to use, and results discussion, and I'll conclude. So let's start with the motivation. So from past few years, there is a tremendous boom in ESG investing. So first green bond, which was issued in 2008, and if you see that today the investment in green bond is increased multiple folds. So from 2013 to 2018, the investing green bonds around 1 trillion, but government banks and companies are thinking to invest more, and there are a possibility of 500 billion more from the 2021 itself. And similar scenario is for the ESG funds, ESG ETFs, and other asset classes. And as this paper is about the green bonds, to give you a glimpse what kind of institutions are issuing green bonds, it's not only the corporate, there are supranational agencies such as IMF, World Bank, sovereign are there, government, local governments, regional banks are there, munis are there, which are issuing green bonds. They are project-specific green bonds. There are asset-backed securities related to green bonds, and similar for the mortgage-backed securities. But most of the green bonds are considered by the corporate green bonds, and this paper is about the corporate green bonds. So when we say green bonds, what is green in it? When they say green, they say that, okay, we are going to use these proceeds in certain kind of way, and they say that they're going to use it for either renewable energy or for the energy efficiency or green building or infrastructures or agriculture, forestry, or other sustainability kind of work like climate change adaptation for mitigation, waste management, pollution control, and similar others. This is what they say. So now the question is, what kind of firms are these who are issuing these green bonds? And how shareholders react to these green bonds in different countries, not only in US, in Europe, but all other countries like Asian countries. And who supports this green bonds issuance? So there are a couple of papers which are important to discuss here, because otherwise there is huge literature in ESG, but just 2 papers I'm going to discuss. First is Tang and Zhang, published in JCF in 2020. We talk about how the shareholders react to green bond issuance. And they say the market reacts positively to the issuance of green bonds, and there is no premium found. That is, the risk component of the green bonds and non-green bonds is same. And stock liquidity and the domestic institutional ownership increases post-issuance. So they say that there's a kind of home bias in the green bond issuance, that the domestic institutions are liking it, and those are the shareholders which are reacting more positively towards the green bond issuance. And Flamer paper, which published in 2021 in JFE, talks about the similar kind of result, that the investors react positively to the announcement of green bond issuance. And she also found that this reaction is strong for the first time issuers, and as well as the bonds which are certified by third parties. So these third parties are actually ESG auditors, and if they are certifying these kind of bonds, market is reacting more positively towards issuance of these bonds. And she also found that the issuers, she also found that the issuers improve their environmental performance post issuance, and she also found the similar results that there's an increase in ownership after the issuance. But there are papers which says that the environmental performance post issuance actually degrade if you see long term, not just 1 year, 2 year, but 3 years, 4 years, 5 years. So Flamer's this result is slightly not robust in that regard. And what kind of theories are floating around regarding this ESG investing? One is the signaling, that firms issue green bonds to give the signal that okay, we are going to do environment wise good in future. And second is the greenwashing, that uh, firms are not disclosing completely what they are going to do with these proceeds. They say something from the surface that okay, we are going to invest in LED certified buildings or fuel cells or similar kind of uh, ESG products, but they are not giving this detailed description or how much they are going to invest. And the third is the cost of debt, that the green bond investors are actually liking this kind of products, that green bonds, and they are ready to take uh, the cost of it, and they are they're taking lower yield for such kind of bonds. So there are three theories which are talking about uh, how the green bonds are actually fit. So what to prove these three questions uh, which I am asking in this paper, that who issues green bonds, how shareholders are reacting to green bonds issued in different countries, and who supports them. I'm using a Bloomberg database. So I collected Bloomberg data from 2013 to 2018. The reason I collected this from 2013 to 2018 because the Flamer's JFE paper collected the same uh, data. So sample period is same. I also have the data from 2019 and 20, and also have other alternative green bonds, which I'm going to talk later. So I exclude the supranational government or similar other agencies green bonds, and which left me with 1,189 green bonds. This number is again similar to the Flamer's paper. Major green bond issuers countries are China, United States, Sweden, France, Netherlands, and Germany. And for firm characteristics and environmental relative variables, I collected data from WorldScope and SF4 databases. So what kind of environment relative variables I have is ESG score or environmental score of the company, or log carbon emissions, or whether the firms are have any target emissions or not. So these kind of environmental variables I have. Regarding firm characteristics is, I mean, the usual firm characteristics like leverage, assets, and all those. And institutional ownership data is from the FactSet ownership database. So green bonds, this is just a stylized fact. So the green bonds are mainly considered few sectors like energy, financials, utilities, and industrials. So if you just club this energy, utilities, and industrials, you will see these are the major polluting companies, right? So it will give you a sense that who is issuing green bonds mainly if you exclude the financials. These are more polluting companies who are issuing the green bonds. And this fits well when they say that they're trying to give the signal that in the future, um, they will try to provide good environmental performance. And 36% of the total corporate green bonds are from the emerging markets. And regarding private and public green bonds, 263 are issued by public firms directly, and 926 are issued by either private or private subsidiary of public firms. Regarding the concentration of firms in this market. In US and Europe, less number of issuers issue more green bonds as compared to Asia. For instance, 191 US green bond issued between 2013 to 2018, 140 are by the one subsidiary of Tesla. A similar pattern is in France, similar pattern is in Sweden, similar pattern in Germany. Regarding the certification of these green bonds, there is a agency which is Climate Bond Initiative, and it has approved ESG auditors. So these companies which are ESG assurance provider and the Climate Bond Initiative gives this certification to these green bonds. So there are 864 green bonds approved by these agencies. And 75% of the bonds in the sample expires at maturity, and 25% bonds include options such as call, put, sinks, and convertible. Regarding the maturity of these green bonds, these are short mature bonds like 3, 5, 7, or 10. There are hardly any green bonds which have a maturity of 15 years or more. So what this table gives you is how many private green bonds are there, how many public green bonds are there, and what is total, and their bond level comparison. So when you're looking at the public, that is column third, public green bond, it includes the public green bond issued by the parent company, as well as the green bond issued by the private subsidiary of the parent company. So I match the private subsidiary to parent company, and that's what it is when I said the public green bonds here. So we have, I have 386 unique events regarding green bonds, and for these 386, I'm going to check how the stock market reacts as a global unique events. Regarding the coupon, amount issued, maturity, certified, and regarding rating, there's not much difference between the private green bonds and the public green bonds. You can see the coupon is around 3.3, 3.2 to 3.3. Amount issued is $243 million to 252, and maturity is around 8 years. Around 70% are certified, and the rating is around AA minus. And this is Bloomberg Composite rating. So what this graph shows that how the market reacts to the green bond issuance in US and the non-US countries. The CAR is calculated as market adjusted returns. Abnormal return is market adjusted return, that is stock return minus the market return. And when I say the market index return, it is MSCI all country index. So you can clearly see that when you just see how the market is of green bond issuance, you can see the dotted line. So you will think, okay, it's market reacting positively to the green bonds. That's a good thing. But when you bifurcate the data into US and non-US, you will see that this is mainly coming from the US green bonds and not from non-US green bonds. And in fact, if you see this -1 to 1 jump, this is because of the Tesla green bonds. So I look into around 19 countries differently, that how the green bonds, how the stock market reacts to green bond issuance. And I use 16, I'm showing here the 16-day CAR, but in paper I have like -1 to 1, -2 to 2, -3 to 3, all kind of brackets. So here you can see that from these 19 countries, in 11 countries, the market reaction is negative. There is only positive market reaction in around 8 countries, and after that, only Sweden and United States has some positive, significant market reaction. So what I did, because as I said, 2013 to 2018 sample was slightly different because the Tesla issued so many green bonds during that time, and United States market reaction was so positive because of the Tesla, because 140 green bonds out of 191 are from Tesla. So I also checked the extended sample, that is 2019 and 2020. And I also checked the alternate green bonds, like sustainability bonds, social bonds, sustainability linked bonds. And market reactions surprising as compared to 2018 2013 2018 green bond sample. Even US market reaction is negative from 2019 to 2020. It's just, and even non-US market reaction is still either negative or insignificant. Negative and insignificant. About the alternate green bonds, I have 118 unique events. And if I talk about the market reaction differently for sustainability bonds, social bonds, sustainability linked bonds, for the sustainability bonds and sustainability linked bonds, market reaction is negative and significant. For the social bonds, is positive. The difference between green bonds and these kind of bonds is the difference of using the proceeds. In social bonds, you use proceeds for like poverty eradication or developing schools or similar kind of things. So it's kind of similar to CSR. And regarding sustainability bonds and sustainability linked bonds, the proceeds are like this, like there's no restriction that how you're going to use the proceeds, but there are some KPIs regarding the emissions or that how you're going to control these kind of activities, environment related activities. So they, I mean, in sustainability bonds and sustainability linked bonds, you are trying to chase those KPIs. And in green bonds, you have to tell upfront that where you're going to use the proceeds. But in short, what I'm trying to say that the market reaction is negative in these kind of green bonds. If you see like alternate green bonds and extended sample. Next I check how these green bonds are as when we talk about regarding the environmental variables, that whether polluters are issuing the green bonds or the non-polluters are issuing the more green bonds. To do that, I match the green bonds and non-green bonds based on country, industry, firm fundamentals. And I use the same empirical specification which Flamer did. Here, the dependent variable is environmental score, ESG score, log of carbon emissions, target emissions, whether the firm have any target emissions for future. And I also check who promotes these kind of green bonds. Like I look for the total institutional ownership and domestic institutional ownership. If you can see in the empirical specification, I have firm fixed effect, country fixed effects, industry cross EF time fixed effects, and country cross EF fixed effects. So I look at who issues these green bonds. And as I was saying, like when I was providing a descriptive statistics, that mainly the polluters are issuing these kind of green bonds. And you can see here that the firms who have higher environmental score, ESG score, log emissions, and target emissions, I mean, those are the firms who are like mainly polluters, and those kind of firms are issuing the green bonds as compared to others. And regarding who supports these green bonds, I look into the institution ownership scaled by the market cap, and I find that the institution investors support this asset class, that green bond issuance. And although the support by institutional investors to these green bonds varies across the countries, and this depends upon the holding of the institutional investors in that country. Similarly, I also looked into whether there's a difference between domestic institution ownership in these, whether the domestic institution ownership different in firms who issue green bond as compared to firms who don't issue green bonds or traditional bonds. I find that these are mainly domestic institutional investors who are supporting these kind of green bonds. But again, the results varies across the countries, different countries. And similar kind of results was found by JCF paper, but they talk about the on aggregate level that there's a home bias effect. So this is not just about the home bias effect, that there's also concern that the foreign institution investors are not investing too much in these green bonds, which which infer that there's a certain kind of information asymmetry for these green bonds. So with that, let me conclude that in this paper, I asked three basic questions about the green bonds. First is, who issues these green bonds? I found that the firm is using green bonds as a tool to signal that the future environment performance would be better. And firms mainly with low environmental score and low ESG scores are issuing these kind of green bonds. And how shareholders react to green bonds announcements in different countries. If we see just the sample of 2013 to 2018, it will give you a signal that, okay, the stock market is reacting positively to the green bonds. But when you bifurcate that data into US and non-US, you will see that the market reaction mainly coming from the US and not from the non-US. And the similar trend, and if you see the data from 2019 and 2020, even the US green bonds giving the negative signal by the shareholders. And so the market reaction is negative, and this is same for the sustainability bonds and sustainability linked bonds, which signifies that the shareholders have some kind of concerns that there's some kind of greenwashing happening. And this can also be learned from the prospectus or the documents they are releasing when they are when the issuer is issuing the green bonds. They are not providing complete information. And who supports this green bond issuance? Mainly the only domestic institutional investors are supporting this kind of asset class, which shows there's a home bias effect, and not foreign institutional investors, which can be due to asymmetric information. Thank you.
Thanks, Ajay, can you take over and give us your comments today? You're on mute.
Yeah. Yeah. Thanks, Jitendra. This is a very interesting paper. This is a very important subject. ESG investment is a gigantic force in the global financial system. All of us need to watch that space, understand what it is doing to asset pricing, and think more deeply about what is going on. And for people who are thinking about climate and sustainability, we also need to think carefully about the extent to which these levers are actually getting anything done, or actually they are not doing a whole lot. So I consider myself a bit of an ESG skeptic, and I want to start with a set of concerns that are a little different from your paper, but it all connects. So when I first heard about green bonds, I thought, but isn't money fungible? So, I could be a company where I have all kinds of polluting activities, and that's fine. But if I'm able to show one narrow project which has some redeeming features, then I can pitch it as a green bond. And suddenly the ESG investors of the world are supposed to be lemmings, and they're supposed to invest in it. And this never seemed very sound to me, because, in this room, we're all finance people, money is fungible. So it's just a labeling system that need not have great consequences. The second big problem in this field, in my opinion, is the fact that the hurdle rates for ESG investors are not lower than the hurdle rates for non-ESG investors. Okay, so we are all economists in this room. We get the basic point of optimization, that a constrained optimization will in general do worse than an unconstrained optimization. So I've always felt the difficulties of being an ESG investor, that on one hand, you have a constrained investment universe, and on the other hand, you're being asked to produce the same returns as everybody else. This seems odd to me. And then you can see the basic incentives for greenwashing are in place, that firms crave low-cost capital, the ESG investors crave good investment opportunities, and they are particularly under pressure because if they actually do a good job of chasing sustainability themes, that's a constrained optimization. So everybody is happy when greenwashing is done and a non sustainability oriented business portrays itself as being ESG eligible. So the basic incentives of this game are wrong, and this will generate all sorts of consequences in terms of the impact. Now let me turn to the firm. If I may talk about what is happening in the Indian landscape. There is a dramatic shift in the corporate financial environment for coal and oil companies. It's much harder to get a project funded. Whereas if you're a renewables company, it's much easier to get a project funded. So, ESG is generating an impact in terms of changing the incentives and the dynamics of how corporate finance people think about this. Now, in that situation, if you were a coal company, then your life is difficult. A lot of the investors say that I am an ESG investor and I will shun a coal asset. Or in any case, I'm thinking the world will go net zero by 2050. So within 30 years, all the coal mines have to shut down, all the coal thermal plants have to shut down, the bulk of oil refining has to shut down. So these companies have a bleak future. In that environment, there is a great incentive for the issuing company to engage in greenwashing and to get its work done by portraying its assets as ESG. Now, if that was true, then the stock market reaction should be positive, not negative. Okay, so watch. I'm the shareholder of a coal company. There is severe stress in the ability of a coal company to get its corporate finance done. Hooray, they've managed to find a loophole. They've managed to do greenwashing and they portray themselves as an ESG investment, even if that's not quite the case. And they managed to access low cost financing. If it was a greenwashing story, then there would be a clear EAR in the event study that was positive. It would not just be Tesla. So I'm not able to reconcile the two findings of your article. So one finding is that polluting companies with bad ESG scores are interested in issuing green bonds. That I get completely. It makes sense that we're in a strange world. Neither the ESG fund managers nor the firms want to do sustainability. And it's a superficial world. You can get away with greenwashing. So both sides want to shake hands on non-sustainability assets and get on with it. I get that. But if that was the case, and if it has indeed happened, certainly in India it has happened, and India is hardly the mainstream of the world in terms of investing. But even in India, it has started happening that coal and oil companies find it more difficult to get their corporate financial structure done, and renewables find it much easier to get their corporate financial structure done. Then, as an equity guy, I should be delighted when my company manages to get financing done at a lower cost than would otherwise be the case. So I'm puzzled and I don't understand how to reconcile these two findings. I wonder what is going on. Would love to hear your thoughts and the thoughts of others on this call. Thank you.
Thanks, Ajay. Jitendra, do you want to take this Ajay's comments and respond to it before we go to opening it up to the rest of the people on the meeting?
Yes, let me read the questions.
Did he say yes? Sorry, Jitendra, did you say
yes? So I think the Rajat's question is valid. That if I got it correctly, that he's talking about that there's a divergence in the ESG ratings by different companies. So like normally, if you take credit ratings, there's high correlation in the credit rating from the different rating agencies, but there's a low correlation among the ESG ratings. So he's saying that I think if I got it correctly, that the ESG ratings or ESG scores I'm checking, whether that can make the difference, because that can be due to the different coming from different rating agencies. So I think the point is valid. I can check the ESG scores or ESG ratings from the different rating agencies for the robustness checks. Thank you.
Susan, Harsh wants to say something.
Okay. Harsh, please go ahead.
Yeah, can you hear me?
Yes.
Okay. So I had a question. Do you have data on differential pricing between green bonds and normal bonds issued by the same? So the average green bond is a 8-year AA minus bond, as I get from your data.
Yes.
What would be the price differential or yield differential between this bond and a normal non-green bond issued by the same firm? I'll tell you why I asked this. Because between the three objectives that you listed out, there is a clear financial trade-off. Both in signaling and greenwashing, the firm is basically signaling higher costs. Because if it's signaling commitment to environment, then it's saying that my costs are going to go up and my profits are going to come down. Now, green bond issuance could compensate for that cost by lowering yields. And so the net trade-off is what I suspect would reflect in the stock price. So the way I read your results is that there is not enough premium on price or discount on yield so far on the green bonds to offset the signaling and the greenwashing negative sentiment that there could be.
Yeah, so I think you're correct in that regard, because why I didn't touch upon the checking the premium for green and non-green bonds, because the JCF and the JFE paper both check into it and they don't find any premium. In fact, this is about the corporate.
But then, sorry to interrupt, but then the explanation is very clear that there is no benefit on the debt costing, and there is a clear signaling of higher costs. So I'm not surprised then that the reaction is negative.
So, yeah, but that's what I'm saying, that the JFE paper and the JCF paper show the positive reaction from 2013 to 2018. So this is surprising for me too. That's why I not just check the 2013 and 2018 data and bifurcate into US and non-US bond, but also look into the 1920 and show that the market reaction is negative. And that's what I'm saying. I am saying the same thing which you're saying. Yes, Hemant. Yes, Hemant.
Sure. Hemant, go ahead.
Yeah, thanks. To begin with, like what Harsh mentioned, that's the first thought that comes to one's mind, that if a firm is issuing green bonds, then its cost would be higher actually, because it would be doing some XYZ environmental things. But on deeper thinking, I have even a counter view. Right, there could be many strands of understanding this. A company is generally doing what it wants to do. So let us say Ultratech is a company. It's a cement producing company. It is doing what it wants to do. Then it has a choice of whether it should go through normal bonds or it should denominate it as green bonds. Right? So that is a second level choice it is making. It is doing what it is doing. So let us say a situation where the investors want to think that since it's issuing green bonds, it is investing in environment related protection activities. So to that extent, its cost will go up. But the lenders, at least, if not the equity investors, the lenders at least will anyway be aware of what the company is doing. If it is doing environment protection activities, whether it issues green bonds or not, they know that its cost is going up. And by extension, equity investors with some delay, they will also get to know of this. So, my point is, in an information efficient market, green bonds, the issuance of green bonds should be at the same price as any other bond. It is just a nomenclature.
Well, yeah. So actually that's what people are finding that there's no risk difference between the green bond and the non-green bond. But the issue is the kind of information they are providing in prospectus, ESG framework, or different documents is not complete. Like they are just saying something about how they're going to use the proceeds. So definitely investors would be concerned about these kind of bonds. But yes, so it's also surprising that there is no difference in the yield. But the problem is JCF paper and JFE paper all check these two things. In JFE paper, Flemmer did the matching part. And in JCF paper, they look into same firm issuing green bonds and non-green bonds on the same day. But those numbers of observations are too low, even to generalize the things. So this is the problem here. And when you do matching, you don't know how good the matching is. So comparison always gives can give some kind of dicey when you're trying to see the yield and combine the yield of green and non-green bonds. But still, they both papers are founding no premium.
So if I can come with a rejoinder here. To test the hypothesis, you need not have a green bond and a non-green bond issued at the same time. As long as a green bond and another bond, both bonds are getting traded at any point of time, you have to compare the premium on the two bonds from the same company, which I guess will widen the data set available.
So you're talking about the secondary market, right?
That's true.
Yeah, so yes. So I'm actually working on that. I'm collecting the secondary market data for these bonds. Thank you.
Thanks, Hemant. I have a question at this point. So the focus in all the discussion so far has been on the firm and what the firm discloses, how the firm issues these bonds. Perhaps one of the angles to actually look at is to ask the question that you asked, Jitendra, but I wasn't sure that I got full clarity. Who are the people who are buying into these bonds? So one of the things that we get a sense of sitting on the outside of the financial world is that not all investment is ESG investment. So there is a pool of people who are happy to do the ESG investments, and there is the normal pool of people who are seeking returns just like they used to before. Is it that the discrepancies or the unexpected behavior that we can see in the premium cost because of the demand for these bonds as compared with the supply of these bonds? It's not the firms, but it's actually the lenders who have different kinds of preferences, which is causing this strange phenomenon that there is no pricing differential between the green bonds and the non-green bonds. So is it that the two pools of investment or capital that's available are fragmented, they're separate, they've got different objectives? And can that be one angle that we can bring into the story? What do you find when you see who are the people who are investing in green bonds as opposed to the normal bonds issued by the firm, as Hemant asked? Are they the same people? Do they just have different mandates? Can you tell us a little bit more about that angle?
Yeah, first of all, as I was saying when I was showing the descriptive statistics, that there are mainly two groups who are issuing the green bonds. One is financial green bonds. These are banks mainly. A lot of Chinese banks are issuing green bonds. There are also banks from the Europe and US. And there's another group like industrial. I'm combining the three sectors here: industrial, energy, and the other third polluting sector. So you can clearly see that this one group, which is like, polluting companies.
I'm asking about the purchasers of the bond. Did you just say that there are three? Yeah, it's not about the people who are issuing the bond, but the people who are buying the bonds.
Okay, so so I mean, if so, I have the data on institutional ownership and the retail ownership. So mainly, the concentration on institutional ownership buying these kind of bonds is more as compared to the retail. And this is, as I said, this is high for the domestic institutional investors. So there's possibility they have this kind of preference for the ESG investing, or there's possibility they are just supporting it because everybody is doing it, or like they are thinking that okay, it's growing, so we should also buy it.
Hey, Susan, this is Harsh. Can I make? Hello?
Yes, Harsh, you're clear. Please go ahead.
The second largest group of issuer is financials, which tells me that the definition of polluter is a bit nuanced. It's they pollute environment in different ways.
No, Harsh, I agree, and we can take this to a completely different level of discussion. But I'm presuming that the financiers who are issuing these green bonds will then have a mandate to go back and disburse that money amongst people who are green firms, or they're buying green bonds themselves. In a certain sense, they are doing an intermediary role here, right?
Yeah. But the green is in the eyes of the beholder.
No, I agree. So here's my problem, right? I mean, we think about the pricing as coming from a supply, which is Jitendra and Ajay both talked about firms, and even Hemant to a certain extent, that firms are doing what they're doing. There are some mandates that they are supposed to match. It's not today, it's in 30 years' time or 20 years' time. It's costly for them to do it today. And the question is, what is the incentive that they have to go out and issue a green bond? That's one set of the behavioral pushes on this entire story. But the second set is the investors, right? The people who are going out and saying that they want to buy ESG or green. What are their focuses, and how does that change the pricing of bonds? When you think about preferences or risk premiums or maturities, how does their behavior or their aspirations change the pricing of bonds when it comes to comparing normal bonds versus green bonds? That's the question.
But I thought the answer was that there doesn't seem to be a material difference between the pricing. That's what, at least what I heard.
Yeah, but okay, so let me jump here. So like actually what Professor Susan is saying, and this can be captured in the secondary market rather than the primary market, because when you use the proceeds, its results will come into next year or after that. So how the secondary market reacts to the use of proceeds in the future, that will reflect the investor's behavior. And this is regarding the primary data. I'm working on the secondary data, which will give you much better answer what you are asking here. And yeah. Regarding the financials, mainly the banks issue green bonds, and then they give the green loans to the companies or the individual people who wants to take loans from the bank and wants to use that loan for any green purpose. So that's how. But even the banks are not giving the full details that okay, suppose nobody came for the green loans, what you're going to do?
No, I agree. So I agree. I think that it's all a bit of a puzzle right now. I just wanted to understand. So when you show the results that you have for the green bond discounts versus the normal bond discounts issued by the same issuer, I'm presuming that you have all else being held constant, right? So the maturity of the bond is the same, perhaps the size of the issue is the same. And then given these two things are fixed, we can say that the premium or the discount on the bond is non-zero. It doesn't exist. So they are being priced in exactly the same.
Yeah. So
the stock market is showing a negative response. But we know that, as Ajay said, money is fungible. So it's the same firm. They've got money coming in from all of these three sources: normal bonds, green bonds, equity. And so there must be a link in the prices of all of these instruments that makes sense. So either you're saying that there is a huge information asymmetry about what green really means, and therefore the market is just pricing it as they would price a normal bond. Maybe that will take time to develop. Or
no, but Susan, sorry, there could be also sequestered investor pools that some investors don't. I mean, look, I know banks, right? They are rainbow issuers. Tomorrow, if they want, they can issue a deep red bond if some investor is willing to buy it. Because they will always find somebody to lend. So they will create a red bond for fossil fuels to lend to fossil fuels. So I'm saying that there has to be sequestered investor pools which are only investing in some bonds, and therefore they are being issued. If there is no price benefit, then the only reason is that you can access pools that you can't otherwise access.
Fair enough. And I think that that's an interesting part of the story that should come into this entire paper, which is what I guess Jitendra will now go out and do using secondary market data, or establishing that there are separate pools of investors who are investing in green bonds as compared to the investors that are investing in the normal bonds. By the way, for a sense of scale, today, what is the size of money that goes into ESG investment as compared with the overall investment market? Does anyone know?
I think the if I remember correctly, is still the overall traditional market much bigger than 5:1 kind of ratio, or 4:1 kind of ratio. Yeah.
Okay. All right. Okay. Sorry, I think some of us have been hogging the floor. Anybody else has a question? Please feel free to post it in the chat, or I believe there's a hands up kind of a thing that shows up.
Oh, sorry, sir, I'm jumping in. Harsh, to your point, there are sequestered buckets of funds. It's not necessarily sequestered investors. Most of the multilaterals, they not today. They have been doing it for years, decades actually. Earlier, it used to be called. It used to be not ESG, but it used to be what is called rehabilitation and social something. I'm forgetting that. So towards that, then it became CSR, then it's green. So in various ways, they do lend at very cheap rates, subject to the condition that the banks will on-lend it to certain specific projects. So renewables used to be one favorite for quite some time. So there is a set of investors who are happy to lend. Actually, they used to be not getting enough borrowers. But yeah, so that is the point.
Thanks, Hemant. So if there are no more questions from the floor, we've got 30 seconds more people. Seven, you had a question on the chat. I hope that that has been answered.
I think I answered the Rajat question. I just want to see 7.
For the question, I think that is about the positive reaction of investors found in the literature is towards stocks of the firm or the green bonds.
It's about the green bonds, because I looked into the long-term and the short-term reaction, and there was no other announcement. I mean, there's nothing else happening in the regarding firm other than announcement of the green bonds.
Okay. And Ajay, any more thoughts or additions that you would like to make to the comments that you had for Jitendra? No, I guess not. So shall we wind this one down? Thank you very much, Jitendra, for your.
Sorry, I was muted. No, I'm fine. We should go on.
Okay, thank you. And thanks, Ajay, for the discussion, and Harsh, Hemant, and the rest of the crowd for comments.